I'm heading our German office in Frankfurt. We have 30 people in Frankfurt. Our activity is mainly focused on office investment, retail investment, and logistics. So the classic asset classes, and we're investing across the risk spectrum. So core plus, value add. That's it from my side.
Okay, great.
Stefan, Schramm, Simmons and Simmons. We are having about 100 lawyers throughout Germany, focusing to a large extent on anything which relates to real estate, from setting up real estate funds together with the Luxembourg office or any other office in the network, and then also the transactional work, the tax work, and financing as well as the equity.
Great.
Alexander Fischbaum, AF Advisory. We structure finance for investors and developers in the UK, Germany, Netherlands and Spain. And we take our clients through everything from the initial presentation all the way to drawdown, and from senior mezzanine pref equity. And it's a little bit complicated. If you hear it's abstract, what we're doing is practical transactions. We're acquiring, helping or financing for our client the acquisition of 150 million, very granular B and C location portfolio. We're helping someone with a disposal. And very interesting, one of our private equity clients decided to keep his assets because it's so difficult to reinvest, and just takes money off the table by refinancing. So these are the different things we're playing at.
Okay, good. Karsten.
Yeah, Karsten, Kohlmann, Waterway Investments. It's fairly simple what we do. We're a transaction advisor with a focus on real estate in Germany, with a focus on non-core real estate in Germany. By that I mean everything outside of the CBDs of the big 5 cities. Based in London and Frankfurt, we kind of help a lot of the PE funds in London to dispose of their more difficult challenges in the German market.
Christian Bodtke from ESTAma. ESTAma is an asset and property manager in Germany. We manage about 4.5 billion euros of commercial property with 12 offices. I head an investment team, and we are disposing, similar to Karsten, more focus on retail, small properties, granularly to the local market mainly.
So Real Capital Analytics is a business tracking transaction activity around the world. Germany is clearly an important market for us, for both clients and also tracking the markets. It's a difficult market to track in terms of sort of transparency in the deal terms, but certainly it's improved over the last few years, and I think the money going in there is certainly helping that. So we're active across the German market.
Okay, great. I wanted to come to you first, Marius, just in terms of the economy. It's picked up, it's expanded in the first quarter, outstripping most of the other major rivals in Europe. Do you think that's going to continue with, we've obviously had the Dutch election and now the French election, which help create more stability in Europe. So do you think that's going to continue driving the economy of Germany?
Yeah, I mean, the first quarter was pretty positive. The growth was around 0.6%, so higher than expected. And at the moment, the political environment is quite stable also in Germany. The next elections are expected to produce a stable outcome, whatever it will be, but no populist parties on power. And the consumer mood is pretty positive, so I expect to continue.
Okay, good. I mean, it's interesting that you pick up the politics side there. Stefan, in terms of the election, so Marius believes there's going to be stability anyway afterwards. What's your sense of that? Is that then, are we going to see another lift once the elections are complete? What's your sense of the impact that might have, both on Germany but also on the real estate side? Are there any kind of particular things that might crop up?
With regard to the elections of Angela Merkel later on, if that happens. I don't think that makes much a difference. We have this stable environment, and this will go on like beforehand, at least on the short and mid-term view. But we have to keep in mind that in Germany we have now the 7th years of growth. So I'm not a macroeconomist, but we all learned that cycles come to an end sooner or later. To what extent these cycles, subject to Draghi's monetary policy, have an impact on the real estate market is to be seen, but it might be that at least the increase will not that high as during the last years.
Okay, that's quite interesting. And Alex, Alexander, maybe picking up that point, I mean, Stefan highlights obviously the fact that Germany has gained quite a lot in terms of asset pricing from the ECB's policy. We've still got low bond yields. From what Simon is saying, there's still capital looking for a home elsewhere, and Germany seems to be on top of the list. So with the economy, with all of those things, can you see that changing, or do you think we can avoid the cycle that we're talking about here? Do you think that's just going to carry on growing, or what might come up?
Well, thank you for formulating the answer. I could simply say yes, but I know you don't like that. I think we're in a super cycle. I must also add that I'm an economist, and everything I learned in university about interest rates has gone out of the window. So caveat this as you like. We're living in a super low interest environment where investments in many other asset classes has become very difficult. You have bonds that have negative yields, so everything has shifted towards hard assets. Then we live in a world driven by more and more uncertainty, where Middle East is uninvestable and it's creeping out. You have major issues in southern European countries because of their country balance sheet or their banking system. We're doing just a little bit of work on the Italian banking system. That's quite interesting. So it is concentrating this excess money that can't find a home in bonds, in real estate, and instead of real estate globally, it's going down to a few countries that are very investable because of their relative political certainty. So real estate is now driven less by economics, but by a very charming and intelligent Italian gentleman in the ECB. If he changes his mind, all pricing changes of everything, including real estate. And more and more on political events, and we've just had the opinion here. Germany is also not hugely stable. I mean, there are huge underlying problems, but it's more stable than the environment. So it's a double funnel that creates everything in Germany. Export is going reasonably well, and as long as things are kept more or less on kilter, I don't think that prices will go anywhere, neither further down nor much further up. So the time of rampant value increase by doing nothing and just riding the cycle, that probably is very much at an end.
Okay, so from your point of view, you don't see a huge lift in pricing. I mean, interesting, your graph, Simon, there was showing the recovery side of that. But you don't see that happening. You think stability is going to
yield compression. I think in Germany I have a problem. We just done research for this big portfolio in the most cities, and Marius can comment on this better than I am. Great. Top yields are 3.3% in Munich, Hamburg, 3.8% in Düsseldorf. Stuff. Where will it realistically go? Rental growth is a different question.
Okay, all right, good. Karsten, you're obviously, looking at money that's coming into Germany. Would be interested to see. I mean, it was interesting from Simon's presentation there that a number of the German cities had jumped over Paris, but that was pre the election. Do you think with Macron in power now that you're going to get investors beginning to say to you, oh, well, actually, I'm thinking about going back to the French market? Or do you see that there's going to be increased competition now between Germany and France that wasn't there before? How do you see that?
No, I disagree. I mean, we see a lot of French investors that have come to Germany over the last 2-3 years, and that trend is kind of continuing, and things are too similar. And I think you have a lot of investors from outside of Europe. I mean, we mentioned South Korea. You have to know that Frankfurt is kind of the South Korean hub in Europe. All the Kia, all the car companies have their headquarters in Frankfurt, so that gives them some confidence. But in general, as Alexander said, well, there's to a degree a worrying trend, I have to say, right? Because what we see in the big cities in Germany is what has been happening in London for a while, kind of a large volatility, right? You can, with core assets, suddenly get opportunistic returns, right? And a yield shift from 5.5% to 4% on a 100 million deal means you make 40 million, right? I mean, and that Germany hasn't seen that over the last 12 20 years or so, right? Germany's always been stable, boring, rents have been flat, and now suddenly Berlin or whatever is going through the roof. And I mean, I don't know whether we Germans were all stupid, but nobody bought in Berlin. But if you bought something in Berlin 5 years ago, I mean, you would have made a lot of money. But were mainly the foreigners that went into the market. And I mean, the reason why the deal sizes are much smaller is probably because a lot of residential has been bought in Berlin. But also the rents are still low, right? And that's being priced in. And there are a lot of processes going on right now. The Sony Center is in the sales process right now. I mean, I think it was bought a few years ago for 600 million. Now they want $1 billion for it. And I think the Axel Springer quarter is being sold right now. And when you talk to potential investors, they said we bid 26, 27 multiple, which was 280 million, but they didn't even take anybody below 300 million into the next round. I mean, that shows how crazy markets have been. If you talk to somebody 3 years ago, they would have said anything beyond a 20 multiple is insane in Berlin, right? So, and yeah, it's been driven from, I mean, we had the discussion at UBS the other week with you guys where they talked about the global impact, where Japan is kind of, the pension funds are freeing up their 4 trillion of money and allocate 10% to real estate or alternatives. And well, we see that trend now in Germany that investors get more daring. They've been to London, they've been to Paris, and now they discover Germany. But only the core markets, I would say, right? In the B cities, C cities, it's a play where you have to know what you're doing and you compete with the locals. Yeah.
Okay, good. I'll have to put down Berlin 5 years ago as another opportunity I've missed to make my fortune,
right.
Sadly. There.
Along with many others.
Yes. Christian, in terms of the market, Karsten there mentioned a few things that had changed over a period of time. Are there key changes that you can kind of see, let's say between 6 and 12 months ago, more kind of rapid changes that are happening? Anything that you want to pick out?
I think we've seen in the last maybe slightly longer period, 18 months, we've clearly seen that a lot of portfolio sales came onto the market and haven't traded. I'm talking about retail portfolios in this instance, which is what we deal with, granular portfolios, and a lot of them have been misguided in terms of pricing and haven't transacted, in fact. That's something that's definitely notable. I think just to add to what Alexander was saying, when you talk not about the core cities but the secondary and tertiary cities, I think there's still a hunt for yield happening. We can see that on smaller assets, so say 2, 3, 5, 7 million properties, which is all you get in smaller cities in Germany because there's no big lot sizes. There's definitely still yield compression happening. Quite astonishing to our surprise even. So even when you sell supermarkets or retail parks, it's surprising how far down investors go with the yield.
Yeah, not only this, you have a very positive financing environment. You know, 5 months, Euribor very close to zero. You add to it a margin of 150 and below. I mean, at that cost of capital, you can buy a lot of stuff. And even if it's only 3/4 let, the cash on cash is going to be very impressive. And that's what our very, very smart clients do. They go to the B and C cities because they cannot, as Karsten and everybody else here outlined, find value in the big cities. Big cities are for parking money, or if you're a developer, then yes. But the B and C cities, and there, it was mentioned before, you have to know a little bit what you're doing. You have to have good advice, and you have to have an asset management team that can deal with German tenants who are not used to a 20-year FRI lease and you sort everything out for me. When you have that, you can find smaller assets or buy smaller portfolios that are asset management intensive. And given the discrepancy between the yield you buy it in and the cost of funds you get from the bank, it still is a very attractive play.
Well, I disagree with the B and C cities, to be frank. I mean, we are focusing, at least for the office market, we are focusing on the A cities. And I think the A cities have a much higher dynamics than the B and C cities, because, I mean, this is where the population growth is happening. I mean, Germany has become, I think, the second largest immigration country after the US. And all the people come into the A cities, not into the B cities. Yeah? This is where also all the people from the rural areas move in. Yeah? So we see the strongest growth in the A cities. I think where you're right is that the A cities have a higher volatility. Yeah? So if you believe that Germany is on a growth path and that we will continue to have a strong growth, then I think you should go into the A cities. If you think over the next years, this will come to a halt, then the B cities are more stable. You have less speculative development, you have a lower rental level, you have a more stable environment. I think then the B and C cities are a good choice. But if we believe in a further dynamic, believe in a stronger dynamic, then I rather would focus on the A cities.
But there's a reason for that, right? Office in German B and C cities, I mean, we're talking about a 8 to 12 euro rental market, and that's why there are no developments in any of those cities apart from the big 7 ones. And the tenants still want the same incentives, right? They still want their nice fit out for 200 euros. They want half-year rent-free period, and if you get 8 euros, that's 100 euros a year. So you give them for a 5-year lease, 3 years incentive, and that obviously you have to know what you're doing in those markets, right? And you obviously hope that you can capitalize that, but that's the major difference from the A cities where Frankfurt goes up to 50 to kind of going down, going outside of Frankfurt 10 kilometers, and suddenly you're at a 8 euro market for a similar quality building. You know?
But that makes it also fairly stable. Because there's,
right.
I mean,
there's no development for
exactly.
that reason, right? There are
Exactly.
vacancies of below 4% in a lot of the cities, and you walk around and every office building looks crap, and you think, why is nobody kind of developing anything? But that's the reason, right?
I think we're saying all very similar things, just from a different point. And the point that Marius makes is one of growth. And I think there I believe your story, because you have a better chance of growth in a large city. What I'm talking about is pure cash flow investing, cash on cash. Forget about growth. Will it come? Good. Will it not come? You still have lots of cash on cash. And that's where many of our investors, filling up their voids and stuff like this, are actually more in the active value creation rather than in the scientific research, which market will deliver the growth for me, which is one of the ideas underpinning your investment strategy. A research-led approach.
Just while we're on the cities, it would be quite interesting just to explore some of the differences between them. Leipzig, I thought was very interesting. Can anybody explain that to everybody, why Leipzig is suddenly interesting? What's happened there? And what are the differences between the cities? Which are the more attractive ones at the moment? Does anybody want to pick that up?
Well, I think Leipzig, I would imagine it's been a few larger deals, probably retail deals that have driven that market, right? Because office rents are so low that you don't get big deals in that market. And it's a residential story to a degree as well, right? If you went to Leipzig 10 years ago, you could have bought decent residential stock for kind of a couple €100 per square meter. So it kind of, and I know people that did that again, where I think, why have I been so stupid, right? And just bought stuff, kept it for 10 years and tripled their money in those deals, right? Because people see Berlin is not investable anymore, but Leipzig is probably something that can have a similar story, Eastern German story, but I mean, if you've been to Leipzig, it's a beautiful city. A lot of companies go there now, a lot for back office because you get qualified people for less money than in the big 5 or 7 cities, but that could be a reason why. I mean, it's just the next thing, right? The parties that get priced out of the big cities look for the next thing, and Leipzig is probably the city that comes after the top, the 7 or 10 in terms of story.
Yeah, the investment volumes will be fairly small.
Yeah.
I think that's.
Does that mean that if you're beginning to get back office functions moving there because of the types of staff, that you may then get the sort of office development that is lacking at the moment, which is kind of what drove some of the markets in Poland particularly? Yeah,
you get some. I mean, we sold a asset 2 years ago in Halle, which is next to Leipzig, and the story was great, right? It was a Tishman Speyer developed building. It was Dell was the tenant, the largest office in Germany, 500 parking spaces, amazing, and just it was in Halle and outside of Halle, right? And rents went up to 14 euros, which is probably the double the kind of market rent there. And I mean, those rents, that's what you need in order to develop in those cities. And that comes back to my point from earlier. You just cannot develop new space. I mean, there are a few developers that do that, where you sign a 10, 15-year lease, and say leasebacks are quite attractive, but always think about what's going to happen when that comes to an end, and I think we would be in trouble there.
Okay. And in terms of the cities, and just Marius, it was a discussion we had earlier, which was what's happening in terms of the competition between asset classes. Is that becoming something that is also maybe driving prices along with international capital? I mean, interesting, we did a session also on logistics where you're getting more urban logistics, so is urban logistics then competing with residential? Is residential competing with hotels? Are hotels and residential competing with office? So that sort of internal competition within the real estate market. How are you seeing that in Germany? Is that driving pricing? What's the position?
I think it is. I mean, what we have seen over the last year is that especially the rents and prices of the residential, rocketed. Yeah. So we see now a much stronger competition between the use classes, between residential and between office in the inner cities, yeah, and even in the decentralized areas between logistics, which is urban logistics, yeah, and light industrial and residential. Yeah. So it's much more difficult to find decent development sites, for instance, yeah, for office investments, and this is driving prices. And this is different to 10 years ago, yeah, where you still had development land in the inner cities, being it industrial land, railway land, or the strip along the wall in Berlin. Yeah. And this is filling up. And now you're competing between the asset classes, and this is also a structural change in terms of pricing for the markets. Yeah.
Good. And in terms of, let's dig down a little bit into some of the asset classes as well. I mentioned logistics. What's your kind of view on that? You're invested in that area in Germany. How are you seeing that? What's happening with the drive of e-commerce in Germany? What are you seeing as the key drivers there?
Yeah, I mean, for logistics, we see that due to the e-commerce, the logistics sector is still expanding, and what is expanding the most is urban logistics. Industrial logistics is still the largest sector, but urban logistics is the one which is growing most, and which we see as the most stable sector and still a growing sector. Yeah? And it's getting more and more difficult to find a product within the major metropolitan areas, yeah, for developers and for logistic providers, because the cities actually are restricting the ceiling of land, yeah, which makes it again increases the scarcity of product. Yeah.
Okay.
It's different for large distribution centers, yeah, which are somewhere at motorways. Yeah, with those we are more skeptical, and we have to be more careful what you do.
Okay, good. And Christian, you obviously mentioned that retail was one of your kind of specialities in terms of the sectors. What are you beginning to see at the moment in terms of, let's say, the split between shopping centres, outlets, and what sort of impact is e-commerce having? Is it a negative one? What's the mix there?
I think the retail investment market thinks that Germany is overshot in certain areas. I think there's recently reports about high street prime pitch rents falling for the first time in a long time, and by quite a few percentage points. So there's challenges there on the high street in terms of what retailers can justify to pay. I think another aspect is in terms of e-commerce. You're asking the whole concept of click and collect, home delivery, etc. How is that revenue captured when it comes to turnover rents? Because a lot of these leases, whether it's in shopping centres or even on high street properties, are based on turnover rents. And if you have click and collect customers coming in there, landlords will have an issue. How is that attributed to that property and reflected in the rent, for instance? But I think when you look at the electronic retailers like Saturn, for instance, they're definitely downsizing. A Saturn used to be 4,500, 5,000 square meters 10 years ago. Now they want 2,500 square meters, roughly speaking. So there's certain parts of that sector are already impacted, whereas food retail hasn't really seen any impact from e-commerce yet, I think.
Okay, so electronics definitely on a downward path because of e-commerce. Food retail so far not, but I think Amazon Prime Food is launching fairly soon in Germany. Is that right?
In Berlin. I think they're testing
In Berlin.
one side in Berlin. That'll be interesting. to see.
But Germany is a bit lacking behind the Anglo-Saxon world, I have to say, right? I've been living in the UK for 10 years, and in my little cul-de-sac there are like people over the age of 70, 80, they're young families, and you see a kind of a Ocado, Sainsbury van every day kind of driving in and out, and I don't think you have that phenomenon in Germany to that degree at the moment. I think it will change, but I think there's more change to come in Germany.
There is also a problem if you look at Germany as a country that is very large and population is much less concentrated than in the UK. And if statistics are right, I think Tesco is subsidizing every delivery with £5 per drop. If you have a large distributed society, you may be able to have economies of scale in the large conurbations. That's why Amazon would start in Berlin, which is the largest German city and has a very high density and centrality. But to apply that Germany-wide, I think it is almost impossible, because the drive distance and the cost of delivery in comparison to the food basket will be disproportionate, and the German shopper is very price conscious. So there is no, we pay £6 or £8 for delivery, certainly not so I'm driving. We'll have the Mercedes and the Porsche standing in front of Lidl in Germany. This is quite standard.
So it would be more likely to be a Tesco delivery than an Ocado one, in that sense.
No delivery.
No delivery. Okay, so
maybe pickup, that would work, but people paying for delivery outside the very congested conurbations, I think, is going to be a psychological shift that the Germans are not easily going to undertake.
okay, and so is that going to be a slow on some of the growth, just the German attitude to e-commerce and those things? Is that going to consistently slow that, or do you just think that it will at some point gradually accelerate?
Well, we are seeing the impacts of e-commerce, yeah, and the e-commerce sector is growing. Yeah. In the food sector, indeed, I mean, we have to see what is going to happen. And I agree with Alexander. I mean, Germans are not even prepared to pay 50 cents for a parking fee if they have to go to a retail park. Yeah, so they are indeed in this respect price conscious. Yeah, but the e-commerce is growing, and actually we are starting to see the impact on retail rents. Yeah, and that's something which is widely recognized in the market. Yeah? And I think electronic goods, fashion, these are the sectors which were affected so far, yeah, and we have to see what is happening to the food sector. Yeah.
Okay, good. And Simon highlighted, obviously, in his slides in terms of the sectors, also senior living, some of the alternatives coming through. What's your sense, Karsten, of that? Are you seeing more interest in student housing? I mean, we've done a couple of sessions here on Germany where we've looked at student housing, micro living, but what's happening in those sectors? Is there more interest that you're seeing picking up on the slides that Simon showed?
Well, it's not really our sector that we are working in, but in general, I think it's the same trend as going out of the big cities into other cities, because they're kind of shopped at the moment. So international investors, and we do the rounds in London, they try to find alternative ways to make money, right? And if office and retail, you have the competition from the big institutional investors, they start talking about what about senior living, what about other alternative asset classes, student housing. Where student housing, I mean, there are a few German players. Some have kind of had difficulties. Some are quite successful at the moment building their brands. But I would always be cautious with that, right? And I was quite surprised to see that a lot of international players go into German senior living, right? Because it's quite a complex asset class in Germany. It's kind of managed on a federal state level, so every federal state has their own jurisdictions when it comes to that. Your cash flow is not as transparent, right? It's not like you have an office building, you have your income, your service charges, and there's a cost going out. Here it is, you have subsidies that come into play, which kind of, depending on what kind of disability level or whatsoever you have, it's in that changing from federal state to federal state, and jurisdictions also change, right? So you cannot really guarantee what's happening in the next 5 to 10 years. And sometimes people say, yeah, but it takes 5 to 7 years until you implement it. But the day the jurisdiction is passed, it's already priced in to a degree. And it's, I mean, obviously the trend goes in that direction, and there's demand. Same with student housing. We need it, right? And it has to grow over the years, but I think it's still an asset class where you have to be, I mean, there's a reason why kind of there's a risk return to a degree, right? Or imagined risk return. Yeah.
And in terms of, I mean, one of the things, Stefan, that's always seen as adding to the stability is the very kind of strong zoning, city planning laws preventing too much development, really. How does that work in terms of if you're wanting to change use, those kinds of things? Because obviously there's presumably a desire to change some of the old office stock into residential, or how positive are the cities, or does it vary between cities in terms of their view on that kind of play?
I would say it depends on the city, of course. If there's a demand, then cities are more and more trying to do that. We have the development in Frankfurt, in Niederrad, for example, which was 5-10 years ago a more purely office area, which has now been developed in a residential area. So it depends, of course, on the city itself, but if there's a demand, and in Frankfurt, what are the estimates? How many flats do we need in Frankfurt? 30, 40,000, and no one yet knows what the Brexit brings us. So there's a demand, and then the communities react on this. But there's another angle, perhaps, to add on what has changed during the last 6 to 12 months. We discussed the diversification in terms of volume, asset, and region, but also on the financing structure side. Until 1-2 years ago, we only had senior loan and equity, and now, to a large extent, the plain vanilla transactions. We didn't have that much in the German market, junior loans and mezzanine financings. And that is something which became now much more popular during the last 6 to 12 months. 2-3 years ago, London Mezz and junior debt providers wanted to enter the German market. They didn't do that much volume, but now it's getting normal. And the typical German Landesbanken or banks generally, they get more and more used to having a junior Mezz lender more junior to their senior finance.
But they adjusted their pricing expectations as well, right? I mean,
yeah.
Like a few years ago, you went to a Mezz lender in London and said, 15% plus, and the Germans were like, you're kidding? Yeah, I mean, in Germany, and it's quite binary in Germany in general, right? Either you get financing from a Pfandbrief bank and then it's very attractive, or you don't get it at all, and then you have to find alternative routes.
They don't go that high in the LTV anymore,
right.
like pre.
Exactly.
Yeah. And there's a gap, because the German banks, in the good old times, they went up with the LTV as well, like with the other banks in the market. But they learned the lesson, and they now keep the LTV still reasonably low, and there's a gap between the equity, which needs to be filled by junior Mezz financing.
And in most cases, is financing available for almost every event, or not necessarily? What's the position? What is difficult to finance, and are there alternative lenders coming in to provide that, or is it just that people then have to, if they want to go down that route, it's got to be an all equity buy?
Yeah. I think one of what Karsten very rightly said, there's always been mezz around in pref equity. We put this into all kinds of transactions. The pricing has come down, as Karsten said. And that makes it easier to deploy, because the investor says, hold on a second, for a certain price, I'm not going to go through all the rigmarole of having a second loan, having an intercreditor, having all that headache. We take this off their shoulder, but it's still a lot of work. But the key thing is that the discrepancy between the very low funding, and you get 78, LTC, whatever else, at so cheap prices that many people say, I just don't bother with the rest. And I have anyway too much equity to deploy, so I'm quite happy to put that in. And you'll be surprised if you explain an asset well, how much things are financeable. If you are talking to the right parties and explain it and have a credible business plan, and what is more and more important in Germany is also a credible execution team, because if you come with an ambitious asset management plan and you have a big team behind you that has done it before, the banks are looking at the current high in the market at assets that they struggle to see much fantasy. But if you have a good asset manager, you'll get it financed. If the same building comes with someone who says, well, I'm going to give it a crack, either the equity requirement goes up much further or you don't have anything. But throughout Germany, even in secondary and tertiary cities, even in secondary and tertiary locations, if the business plan makes sense, you explain it well, and you live with the time frame of the banks. They're not as quick as the London-based banks. You will get finance, and good finance.
I agree. I think if you can get finance if you explain and you can prove that you can execute it. If you look on a broader basis, yeah, and this is for specific assets, yeah, and specific situations. If you look on a broader basis, you still find that development finance is something which is where banks are very cautious.
Yeah.
Yeah. So and if you look, for instance, at the pipeline, yeah, you have at least 50% pre-let of all projects which are currently in the development pipeline. Yeah. So financing speculative developments is not easy in Germany, and this is also one of the reasons why we don't see a big supply pipeline, even though we have strong demand, yeah, in the office sector.
Okay, good. I just wanted to come back a little bit to you, Simon. When you showed the slide about Germany's position versus the UK and that it had taken over for that period of time, and we haven't discussed Brexit yet, but I'm just about to bring it up now. Do you think that is going to continue? Or do you think that's just this little point in time? Or do you think there's, in general, that Germany may be a beneficiary of Brexit, and so therefore American money, Asian money is going to be looking more at Germany than it is at the UK for the next period?
Brexit's a difficult sort of whether you can pin. The real estate sort of process is so long in terms of buying deals that it takes sort of 6 months and longer. Whether you can pin changes like this, which have been within a reasonably short period of time, whether you can pin them on a specific event is really tricky. Particularly as the UK started slowing down way before Brexit, so it's not entirely clear. If you look at some of the corporate buyers in Germany, none of them have been really related to, you've got obviously JP Morgan buying in Dublin. We've seen none of that in Germany. We haven't seen anyone particularly buying buildings, but that's pretty rare anyway. We haven't really seen a huge change in the leasing market as such. So far, I don't think that's really been driven by Brexit. I think one of the things the UK got very expensive is the major driver. And it's had a recovery from 2009 through to effectively still going at the moment, but sort of slowed down a little bit. Germany didn't have that same sort of early surge, and it's now had that surge over the last 3 years. So everything's recovering a little bit later, and I think Germany is riding that wave, and I think the capital is continuing to go into the market because there is opportunity. Some of the domestic players are selling, or they're moving assets elsewhere. They're moving maybe out of the main cities where they can see price opportunities to sell out at good money, and move into some of the cities they're also familiar with, which cross-border investors aren't. So, short answer to your question is yes, I think Germany will continue through this year and maybe a little bit beyond being that number one market, because I can't see anything that's really going to push the UK back to the top. The question about France and Paris, there's other issues in France rather than just the change of president, so that's going to take a while. Sort of those reforms and all the things that are needed are going to take a while. So I think Germany will be number one in Europe for a while.
Okay, good. And Simon mentioned there obviously that round one of the Brexit office moves was won by Dublin with JP Morgan. Germany going to benefit or not? Lots of discussions about Frankfurt, whether it's too small in general to be able to really increase in size, but obviously that's a natural home for banking. What's your sense of the potential benefit? Do you see people moving there? Do you think there are going to be movements, and do you think Germany will be a beneficiary of that? And if so, which cities and why?
Well, I definitely think, I mean, it's not going into the opposite direction, so Germany will profit from it, and I think Frankfurt will profit. And one reason that an Irishman mentioned that kind of the other week is that Dublin's regulatory authorities are not even set up to kind of deal with the trading volume that potentially moves to Dublin. I mean, that's all those things where you have in Germany quite a established kind of system in place, right? And that's kind of things where you don't think about. Obviously, you have the language advantage in Dublin, and you have nice pubs and Temple Bar, which we don't have in Frankfurt, but I think in general, Frankfurt will profit. Berlin, to a degree, will also profit, but Berlin is the growth story in Germany, but I think that's pretty obvious. I don't know about Madrid and other cities, and a lot of speculation around that, but...
And Berlin, because that might be where businesses set up their European headquarters rather than finance, presumably.
Yeah, once that airport is built, which has been going on for many years, but definitely, right? I mean, if you talk to a Berliner or about Berlin 10 years ago, everybody would have shook their head, and no company would have gone to Berlin. It's only government agencies or the German railway or whatsoever, but that has changed, right? And will continue to change, right? And we talked about asset classes and everything, and you will ask your 500 million question later as usual, and I would still go into Berlin residential, even though people might say it's been a crazy ride already, but if you look at prime developments, I mean, there's Uli here in the audience that just built a high-end luxury development, and they're now selling out the penthouses for 8,000–9,000 euros per square meter, and I would still buy those because I know in 10–15 years they will be at 15–20,000. I mean, that's a fairly sure story in competition.
And just maybe brief comment on Frankfurt and the impact on Brexit. And I mean, at the beginning of the year, my colleagues here also asked me, what do you see in Frankfurt? And I said, well, I don't see anything. Yeah? And I think if I now put some data points together, you're starting to see some things. Yeah? But you're not starting to see a massive move at the moment. Yeah? But you are, I mean, if you look at announcements from BaFin, so the financial regulatory authorities, they're saying there are around 20 banks with whom they are in discussions about putting the headquarters into European headquarters into Frankfurt, or asking for a banking license. And a double-digit number of them is fairly advanced. Yeah? If you talk to agents, brokerage, if I talk to my colleagues from brokerage, CBRE, they are saying, well, there are searches in the market. Yeah? There are at least 2 searches with over 5,000 square meters from banks out. I mean, from Britain. Yeah? Who are looking into space in Frankfurt. Yeah? You're seeing these data points. Yeah? I think no one expects that suddenly you will have a double of banking employees in Frankfurt. Yeah? At the moment you have 70,000. Yeah? And if, I mean, the most realistic estimate I have heard is from a Hilabar researcher who said, well, maybe between 5,000 and 10,000 people over a longer time will relocate to Frankfurt. Yeah? This would be a massive impact on Frankfurt, because it's, I mean, when you have 70,000 bankers and then you have 7,000 more, then it's 10% increase, plus then some advisors, etc. Yeah? So it has an impact on Frankfurt, but it's not that suddenly anybody expects that Frankfurt will become the financial center of Europe. Yeah? And it will be probably spread across more than one location. And German politicians are not very keen. I mean, on the national basis, yeah, no one is thinking, how can we steal banks from London into Frankfurt? This is something which is not very close to the heart. It's close to the mayor of Frankfurt and maybe to the prime minister of the state of Hesse. Yeah, but if you look at Merkel, they frankly don't care. Yeah, they didn't care when we had this merger of the stock exchange. They didn't care whether the headquarters of the integrated stock exchange moves to Frankfurt. Yeah, banking is not something which is close to their mind. Yeah, but nevertheless, I think we will see it happening to a degree.
And one of the things actually we haven't talked about really here, and was a big topic certainly a year ago when we did a session on this, was the refugee crisis, which seems to have disappeared out of the news at least. I don't know what the position actually is in Germany, whether it's truly disappeared out of the news in Germany as well, or what's the position? Has that kind of now settled, or is there, because there were lots of discussions about the impact on real estate and what that would mean, but what's the position now?
Fake news.
Nothing? No change? No?
Mid-long-term view perhaps, but there are so many other things around which are probably more important and have more impact on the real estate market than that. That is my...
Yeah, you see it maybe in the daily lives, right? I've grown up in Frankfurt, and they're like the main shopping street or around the train station, and you saw years where it's become better and safer, and over the last few years the development is definitely going backwards, that it's become less safe to walk around the city center in certain areas, and you see what is happening, which can be probably credited to that to a degree. But at the moment we're also selling an office building in a city where across the street like a new development has been built, and then we found out it's actually a refugee camp, right? And didn't deter the international investor to actually go through with the deal, right? So I think you hear a lot of stories, but I haven't seen any negative impact from it in terms of real estate investment.
Okay, good. And Stefan, in terms of anything on the regulatory, tax, legal environment, are there any changes or planned changes maybe from the political side that might have an impact on any of the investors here in the room?
Something which has been implemented is this so-called rental brake with regard to the residential market, that newly leased out properties, flats may not be rented out with an increase of rent of a certain percentage. So we discussed that yesterday, that has been priced in probably, at least by some investors. But there are also quite notable exceptions to this rental brake, that with regard to newly built offices, flats, and refurbished flats. So this has been implemented and priced in by some investors, probably. Something which is under discussion, where we are not yet there so far. There was a possibility to escape the real estate transfer tax in Germany with a share deal. If you keep a certain percentage of the shares of the property owning company or sell it to a third party, to another party than the investor itself. This has been discussed, and there will be changes, and this is something to keep an eye on, but it's not yet there.
And the impact of that would then be that people who at the moment can shelter from the tax.
Transfer tax, which is quite high, depending on the region. So.
And is that something which is kind of both sides of, so irrespective of who gets into power, that's something that the government will aim to progress, i.e. people, it's something that's been noticed that people want to ensure that people do pay that transfer tax, or is it coming from politics is what I mean?
Yes.
Okay, so it's more likely that they will try to find a route for it.
Yeah. Then perhaps thereafter, as always, there will some smart tax lawyers will find a way to escape from that again. But but they noticed that and they picked that up and they want to do something on it.
Okay, good. One of the things that was mentioned earlier was in terms of increase in terms of people moving up the risk curve. Does that mean people are moving more towards B and C cities where there's smaller lot sizes, less liquidity, or does it mean that people are really choosing to go for value add situations in the larger top 7 cities?
It's very difficult to find something value add priced in any top 7 city, to be quite frank. We work predominantly with private equity firms, and they struggle. They absolutely struggle. So B and C cities, in those B and C locations, with very heavy asset management, and that's what gets the returns. Otherwise, it's very difficult unless you do ground-up development, which one of our clients is doing in a top 7 city. Got reasonable finance for this, speculative, but that is a very high-risk game as well. So most of our clients are focused on cash flow. cash flow is more in the B and C cities.
Yeah, I think in general, this whole definition, I mean, we have so many conferences and then there's a core plus panel, a value add panel, and nobody can really tell me what it means, right? I think it's an investor-driven definition, right? Where investors said, I want to invest in value add. That's like a 15% plus IRR return, and they notice that they don't get deals, so they say, okay, we want to invest in core plus, which is probably 10 to 13%. But it's actually the same product that has been value add a few years ago, just under a different umbrella for the reasons that Alexander just mentioned, because you don't get a pure value add play in Germany anymore, right? And even the core play, I think, has become a risky play, right? If you buy something below 4% in a German city, I mean, you just have to move out. I mean, the Londoners know all of that, right? But by 25, 50 basis points and you lose all your equity on the deal, or a large chunk of it, right? So it's tough, right? And I think it comes down to, in Germany especially, that we deal a lot with London and Germany, that you have to be on the ground, right? I mean, the first question that people in London ask me is always like, do you have a good operating partner? And then the next question is, do you have a deal, right? And that has really changed over the last 2 years, that people understand you have to be on the ground, because if you're on the ground with a good team, you definitely have an advantage and you can go into those areas that Alexander mentioned and make money with it. But if you don't have that team on the ground, then it's difficult. Yeah.
Okay, good.
I would just add,
Yeah.
because I'm the resident fact man, I'll just throw in that private equity firms as a group, in terms of a group of investors, have been the only net disinvestors over the last 18 months. So that gives you a sense that they're finding it very difficult to make returns by putting new money to work, but they're finding it easier to sort of make their returns on the exit, because there's lots of non-value add to some degree capital coming in trying to get those assets. So they're finding the opportunity to sell, but not to buy.
Okay, good.
The US, for example, yes, there's a lot of private equity money in there, but it's also, there's institutional money coming in. But you can still be a very large investor, but still be selling more than you're buying. So you can still be a net seller. It's difficult, because I mean, even if you look at some of the private equity firms, some of the assets they're buying now are, they're more towards the core end than they are the value add end. Maybe they've got plans for them, knock down, rebuild, who knows? But it's certainly, I think you're seeing less deals at sort of at the really extreme end of value add opportunistic development. You're seeing very little of that happening of those investors. So it's difficult, because it's hard to tell when you look at an asset from what we do. You just look at a pure asset, what's being bought, whether it's value add, whether it's core, what the underlying strategy is for that asset. But I would say it's a small percentage, which is really pure value.
What's foreign investment of that big chunk of German investment? What is foreign investment versus domestic? Is it 20 to 80, or is it 50-50?
It's at the moment it's about 47-53, so 47 foreign. So it's not quite.
And if we say that most of the foreigners, would you say in Germany most of the foreigners that are coming in are chasing higher return than core?
No. If they're from Asia, then they tend to be. They're the ones driving those 3% yields.
But on your graph, Asia didn't exist. It was just US number 1, UK number 2.
Well, that chart was only over Q1.
Okay.
So if you look over a long period, you'll see more Asian money coming in. So, but yeah, it's the Asian money driving the sort of the high end yields, and then a lot of the money going into sort of the top 7 markets.
I mean, in the big 5 cities, you're right, the investment share of the foreigners is quite high, probably in the region of 40%. Yeah? If you look overall in Germany, and if you look over longer, I mean, let's say the last 2 years, 3 years, the share of foreign investment is much lower. Yeah, it's probably more
outside of the major cities.
I mean, overall, including major cities, but also including all areas. Yeah, I think then you are more in the region of 70%, 50%, which is probably German. Yeah, then you have 20% European, or 30% European, and then you have 20% US. Yeah.
I can only go by the numbers we see, but it's certainly at the moment it's running at about 47% is foreign. Overall Germany, and then it's larger in the big cities.
Yeah, and if you talk about categorization, I mean, you have to differentiate between a value add return and the value add asset, actually, right? A lot of those investors that came into Germany, I mean, one party is Orion. They bought this Credit Suisse portfolio 2 years ago, and the whole market saw it, and everybody said, you guys are crazy paying book value for those assets virtually, right? 50, 100 million more than everybody else bid. And they profited from the yield shift, Berlin assets, Hamburg assets, and they will make proper opportunistic returns on core assets, because Berlin, they probably underwrote with 5.5% and those went to 4%, and the same stuff in Hamburg is happening. So they are an opportunistic investor, but made their money with core assets at the end of the day, and they are the net sellers at the moment. Yeah.
Maybe what might help me is if the CBRE investors, if you have funds in all different spaces, do you see more interest in the core or the whichever?
I mean, I agree with you with my other panelists. It has become difficult to distinguish between core and value add. Yeah? If you ask me, for instance, because what we see at the moment,
core is 3 point something around percent.
You can't define it simply by the percentage.
Okay. I mean, in this sense, we see more interest in core assets. Yeah, but because the core pricing is so aggressive, typical core investors are moving up the risk spectrum, and then they are investing into CBD fringe locations, or in the A cities into other established office locations, what we see more and more, and then it becomes a kind of core investment, more or less, And also in respect to leasing risk, I mean, everybody is expecting rental price to increase in Berlin. So people are prepared to pay. Some people are still prepared to pay 3%. Just betting on the rental increase in the future. And are prepared to take risks on short-term leases or risk on a certain amount of vacancy. But they are from, let's say, from the perspective from where they come from, it's institutional, long-term oriented investors. So I think the definition of core is slightly changing.
Well, I think to add to that, those what used to be value-add investors, they're still more focused on location than the return they can model with much more secondary and tertiary assets. So when you look at smaller shopping centres and 50,000 people towns. We sold a couple, they were on the market for a year and a half, and they grew into the market, and eventually we found someone from Berlin with a good asset manager who was willing to go there, but 40,000 people town, big lot size, not a lot of liquidity there when it comes to the exit.
Yeah, I think these whole descriptions have become much more fuzzy. I mean, it was a couple of years, you could draw it very defined because investors stuck to certain assets, certain cities, certain size, age of building. But because the market is so tight, people have to weaken their investment strategies and become more flexible. And with this whole core and thing has gone more, less and less precise. And quite frankly, if you're on the buy side and you're talking to the vendor, he has a value-add asset, and if you're selling it, the same thing a couple of years later, it's a core asset you're selling. You've done a bit of management work and you just put a different slant on it. So I think this labeling has become a little bit less helpful in a constrained market as it is right now.
Usually value-add investment requires some form of distress. I mean, in order to find a really good opportunity to be able to buy, and some form of active asset management. And at the moment you find rarely any distress in the German market. I think where the distress will come first is in retail centers, in secondary towns, because you see the impacts of e-commerce. There's a certain uncertainty around it, and investors can't. At the moment, some investors start feeling uncertain. What is happening? Is there going to be a repricing of rental levels? And then you see much less interest than in office transactions at the moment. So this will be. I mean, it's evolving. We don't see it as hard facts, but I think this will be, centers, secondary shopping centers, which require active asset management and a deep understanding of where rental levels will go. This will be the assets where you can probably do value add in the next phase.
I've got a couple of very quick last questions, one of which is we did the deal of the decade a couple of weeks ago, along with RCA and Simon. And we maybe do deal of the year possibly. So far, out of this year, what would be does anybody got any suggestions for the deal, something that could be the deal of the year in Germany? Has anything happened in the first quarter?
I think Hanstein calling the market was definitely a notable news alert that we looked at twice. Wow. So they call the market, and part of that is they obviously are nominated in pounds, and there's a massive depreciation in the pound, so the gain is partly there, but there's partly a gain in the assets as well, where they've made another 15% on book values roughly, and they shifted the whole portfolio to Blackstone and M7. I think that was a bold move.
Okay. Handstein bold. Last question to everybody, and we'll be quick. You can, and we're going to have your personal money this time. So it's you're investing your personal money because that's how Karsten started. So for everybody here in the room, how would you invest your personal money so that we can make money out of Germany? Where would you invest it and why?
Well, I would invest it in one of the big 7 markets, in an established location, possibly a CBD fringe location, in offices, under rent, and leased to a boring tenant. Yeah.
Okay, boring tenants, very good.
A city, residential, and if you have the know-how, development.
Okay, good.
Probably not a city, certainly not development, cash flow driven, smaller and value add opportunities that allow me to create value, whatever the market does.
Well, to a degree, the B and C city play, because that's our world, right? So we know kind of what we are doing there. But as I mentioned earlier, the residential play, I think, is still quite attractive because Germany is just like it's a giant awakening in that world, right? In the UK, everybody knows the property ladder. You come out of university, you want to buy your first flat and do something with it, and then get some equity out by the next. Whereas in Germany, we don't even know what that means, right? In Germany, there are people that rent their whole life because rents stay stable. It's a boring play. You buy a house for 400,000, and 20 years later, you will sell it for 400,000, right? So it's kind of been the German story. So cars were more important than residential. But that has changed now, right? I mean, when you see what's happening in Berlin and all those cities, and suddenly people start investing in residential real estate, and I think that will continue over the next years. So.
Okay, Christian.
I'd agree on residential. I think that's got a growth story, especially in growing cities. Maybe food retail, but those food retail properties that have got planning consents you can't replicate. In locations that will always be trading for that.
Simon, you can either...
No, personal money. I stick with my family's business, which is hotels. So we've got the in-house expertise, so we'll do that, and it's also the sector that's doing the best at the moment across the whole of Europe.
So hotels.
Hotels it is.
Very good. We've had a marvellous spread there of different. And all I would like to say is now, if you could join me in thanking the panel for an interesting session this morning. Thank you.